Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go.
Welcome to another edition of the Retirement Roadmap podcast brought to you by SHP Financial. Today we're joined by advisor in the office, Chris Willis on Team Matt. Excited to have you here, Chris. I know one of the things that you and I were talking about prior to this podcast was, you know, as we meet with families and families come in and they're setting up or getting ready to retire, I think one of the main questions I get asked is, do I have enough money? Can I do this? Is this possible? Or what is possible with the amount of money that I have saved? And to me, that all anchors back to one thing, and that's income.
Correct.
Right?
Yeah.
So, you know, when most folks come in at SHP Financial, we believe that you need 5 specific areas looked at and addressed now and ongoing. That's income, investments, taxes, healthcare strategies, as well as estate planning or legacy planning. And these 5 areas continue throughout your retirement because laws will change, rules will change, tax codes can change, and you need a team to be able to sit with you and address these areas as they do change. So again, anchoring back to income, you know, that's kind of the main thing. And there's different ways to drive it. I always say there is no retirement if you don't have income.
Correct, yeah.
So, you know, some of the families maybe that you've been working with or some of the situations, I guess, when you're addressing income, what is it that you're first kind of looking for? How are you building out the plan? Maybe take people through that.
Sure. Yeah, I think the biggest thing that we really dive in on is just someone's like expenses, right? And I always dive in, and I start with that too, because I want their expenses to consist of everything, right? Obviously, they're going to add up their mortgage, their insurance, their taxes, and stuff like that. But I'm like, no, like, you know, what do you want to do for travel? What about lifestyle stuff?
You're not going to sit at home and watch TV all day.
Yeah,
At least I
exactly.
hope not.
Yeah, you're going to have all the time in the world. Like, what are you going to do with it, right?
Exactly.
So we dive into like expenses and all that to make sure that we kind of, as advisors, have a target, right, to plan around. Because I think true investment planning is not, you know, what's the best stock in the world and all that. It's really about, you know, driving income, right, in terms of what they need, right? Obviously, when you satisfy their income, then you can be a little bit more creative and such, but really focusing on their income, their expenses and such like that, because, you know, everyone we meet for the most part, they're going to have Social Security, right? Everyone's going to have Social Security for the most part, unless you retire young. And then, you know, maybe some people are lucky enough to have pensions and such like that. But a lot of times we do see a lot of people that just have Social Security.
Absolutely.
Right? And
I would
then,
say the majority.
Yeah, exactly. And then obviously they are voluntarily giving up their income when they retire. So they kind of say, hey, you know, Chris, Keith, you know, I have this portfolio. This is what I've saved, but I'm about to give up that salary or whatever that may be. How do we fill that gap? Mm-hmm. Right. And I think that's where SHP, that's where we've had a lot of luck in explaining that. Like, hey, you know, there's numerous ways to generate income from a portfolio.
Correct.
Right. And I see it all the time. Personal finance is personal, right? So the way or the, you know, the philosophy that you want to take to generate your type of income or the income that you need in retirement, you can go down different paths, but, you know, not one strategy fits on a specific family, right? You know what I mean? Everyone's different. Everyone has their own way of going about it.
Yeah, you're right. It's really, like you said it best, personal finance is personal. So everyone's going to have their own bias, philosophy, thought process around how they want to, you know, fill what we call that income gap. Take a look at your expenses. What are you getting in fixed income, whether it's, you know, rental income, pension plans, or, you know, Social Security, something along those lines. And then most families we deal with have an income gap, and it's how do you fill that income gap? And what I always ask folks is, most of the people we're meeting we're meeting at, their retirement age a little bit after maybe, or a little bit before, but they've been working maybe with, or they've been putting money into their 401k, or they've been working with another advisor, and their advisor's maybe taking them through the growth phase, but now they're looking for more of that whole, they've done a good job saving. They've, maybe that advisor working with them when they first started saving, and they've amassed all this wealth. And now they're like, okay, well, I need to be a good steward of this wealth and be able to take care of this wealth and be able to pass this wealth or work with this wealth more efficiently, right? Whether it's fees, taxes, estate planning. But it's really, I always ask them, okay, like, what is your advisor's investment philosophy? And here at SHP, our investment philosophy is you need money for certain situations, money for safety. This is your emergency account, money that you can get at, your boiler breaks, roof leaks, you need a new car, whatever that is. Then what we always see is people have that bucket. Mm-hmm. And then what we also see is people have one of the other buckets, and that's that growth bucket. So, most people come in, they have most of their money in that growth bucket.
100%.
And no one's ever kind of defined that third bucket, which we call safety, income, that income bucket, right? Like, how are we driving income? What assets are dedicated to drive income? And then growth. And what I always say is, in that safety bucket, in that income bucket, if we can kind of draw a line right there and say, okay, on this side of the ledger, we have X number of dollars, and that's going to get you through the next 10, 15 years, 20 years. We can be as aggressive or as conservative on that growth bucket as you want, because we technically don't need that.
Correct.
See what I'm saying?
100%, yeah.
So a lot of folks don't have an investment philosophy, and we do. And that's really, I think that helps our clients and the families we work with conceptually visualize their retirement through good times and bad.
Yeah, no, exactly. And you made a good point, is like, I would say, I don't know, 80% of the people, maybe even higher, of the people that we meet with, they say, hey, I have this portfolio, and we look at it, okay, well, maybe they're 65 or whatever. And so you understand that you're 95% in equities and 5% in fixed income. And like, okay, and then we did like the cash flow analysis, and we're like, hey, you need, I'll just say 50,000, 60,000 a year from your portfolio, when you retire, correct? And they're like, yeah, absolutely, based on like the cash flow and all that. And they're in, again, obviously aggressive portfolios can work out really good for you, but there's no rhyme or reason behind the equity portfolio or whatever they're in, right? So that's where we have luck. We've come to people and say, okay, well, let's just say a client does need that 50 to 60,000 a year of income from their portfolio, right? How do we get that? And that's the income sleeve of it, right? And I think at SHP, and I'll kind of dive into just like different philosophies of like that 50 to 60,000 a year income gap. How do you generate it, right? Because there's trade-offs, and I tell people all the time, there's really like no free lunch in the investment world. Yeah. You know what I mean? Like
pros and cons on everything.
Yeah, literally. So, often we meet with all different types of people, and some are very conservative versus some are very aggressive, and some people love the stock market. Some people can't stand the stock market,
Absolutely.
Right? And they can't really deal with some of the volatility. So there's kind of three different investment philosophies that focus strictly on income planning, right? And how do we take someone's investments and generate that income, right? Again, I'll just start like the most conservative vehicle out there, right? That if we meet a client that's super conservative, really doesn't have a taste for the market or really enjoy it or really stresses them out, a lot of the times we can really kind of guarantee some sort of fixed income through like an annuity or something like that, right? And to come back to the part of no free lunch, annuities are, think of like an annuity. Obviously, there's different styles, but it's kind of like trading your investments for a pension-like income.
Exactly. You're creating your own private pension.
Correct, yeah. And obviously that comes with lots of guarantees, lots of peace of mind, whereas like, hey, you're going to have your Social Security, you're going to have this, and you know every single month that this is going to come in.
Mailbox money.
Exactly, yeah, 100%, right? And it kind of protects against longevity risk, right? Because the biggest thing that we see people worried about is, hey, am I going to run out of money?
Yeah, their parents lived to the mid-90s and late 90s. They're like, in their mind, they're thinking the same thing.
Right.
Do I have enough?
Correct. Yeah. So the annuity route is like an awesome route that obviously we dip our toes into a little bit with a piece of the portfolio from time to time based on the situation. And that's, again, very specific, but obviously you have to be aware of the cons of that situation, right? Where obviously annuities are that mailbox money, the guaranteed money, really peace of mind money, but then sometimes you lack growth. Obviously, it's not completely invested in the stock market. You lack a little bit of control. And you're going to have to deal with that trade-off if that guaranteed pension-like money is important to you. You just have to be aware of what's on the back end of that. Yeah. Okay, well, you lose some control and all that, But still, some families, they really, really love that idea. They say, hey, I don't care about flexibility. I don't really care about the control aspect of it. If you can guarantee me this, then I'll be happy, right? So I think
They can sleep at night.
correct. Yep. So I think the annuity route we dip our toes into a little bit because it can be a good solution for some families, not all families by any means, right? So that's kind of philosophy number one is, okay, do you want guaranteed income? We can go down this route, right? But then other options are some people say, hey, I like the idea of guarantees, but I don't like the ability of lack of flexibility, right? So, okay, cool. If that's a concern, then we X off that box, we move on to number two, right? And where we also have been recently, obviously it helps that interest rates are high, is like the dividends and the fixed income type of strategy, right? Where if clients want more flexibility, but you still do need to rely very heavily on your portfolio for income, right? You need it not necessarily for growth, but for income. The dividend portfolios and trying to achieve maybe a 5 to 7% yield via dividends, right? And I say dividends, I mean dividends and interest, because you can obviously mix in some high yield bonds, private credit, and stuff like that. The dividend strategy has been one strategy we've actually had a lot of luck because it has flexibility, right? Obviously, dividends aren't completely guaranteed like an annuity would be, but it has a lot more flexibility to it, right? So the dividend strategy, and I guess I could give our explainers a quick rundown of dividends. Basically, I explain this to clients as you're trying to live off the interest that your portfolio produces.
And that's what a lot of people come in and be like, that's how my parents lived. You know what I mean? So I want to try to replicate that strategy. And the problem is in the late 2000s, 2010s, for lack of a better way of putting it, interest rates were like zero. So that really wasn't that option. So you did look more towards a strategy like that. So yeah.
Correct. Yeah. So I see a lot of people who it's funny. I could think of a client right at the top of my head. The first time I met them, they said, I want to live off my dividends. And then that principle, because the dividends, obviously they produce, call it I'll say 5% yield, right? But that stock or that equity ETF or whatever that may be, obviously there's crazy covered call strategies nowadays. That should still get some sort of appreciation.
Yeah, that can fluctuate upwards, which is nice.
Yeah. So the whole idea is income plus some moderate appreciation. And I can think of a family said, Chris, I want to live off the dividends. Give me 5 to 6% yield, and whatever that basis is, I want that to go to my kids and grandkids, right? So it's kind of like a really personalized plan, right? Where you can use dividends and fixed income, private credit, real estate investment trusts or whatever that may be to drive that 5 to 6% yield, live off that 5 to 6%, let the basis kind of grow and pass on to family.
Yeah, and the good news is it can be quite diversified. So it's not all eggs in one basket strategy. You could have 12, 15 different ETFs or funds in there. Some might pay a little bit higher, maybe a little bit more risk. Some might pay a little bit lower, a little bit less risk, diversified throughout to get you to that 5% yield.
Yeah, and I think that's a nice good note, Keith, because a lot of the concern with dividends, hey, that, Chris, that 5% yield is not guaranteed. I'm like, yeah, it's not guaranteed. I can understand that. But again, we're not investing in individual stocks like J&J or Coca-Cola or whatever who are dividend payers. We're doing a huge, broad mutual fund, ETF, some covered call strategy, some private credit strategy that the yield, yes, it's still not 100% guaranteed. There's obviously market fluctuations. But if you take that and really diversify it out, there's a good chance that you're going to stay around that 5% target because of all the diversification around it.
And if something does slip, you could tap a different part of the market. And obviously the market shifts. So there might be more opportunity as the market moves, as years go forward. And that's why, our team, our investment team and investment committee is so important to us because we're able to rely on them. Hey, look, Mr. and Mrs. Jones are looking for a 5% yield relative high quality, and they come back to us with different strategies to help us achieve that goal. But not only that, we're monitoring that ongoing. So as things change, we can bring in new ideas, new strategies.
Yeah, 100%, right? Yeah, so I think the dividend strategy has been, again, it's not easy to do, but it's been easier with higher interest rates, right?
The cons are.
Yeah, and then the cons are the people who, because obviously, again, the idea is that dividends, there's no guarantees, right? So the basis of the portfolio, right? I'll make up a number. Say it's $1 million portfolio that yields 5%, right? Obviously, that's $50,000 of income that it can generate, but also that $1 million is going to move up and down, right? So if that, if basically the client is extremely conservative, and then the dividend strategy might not be the best strategy for them, because if market volatility, right, causes concern, well, yeah, you might still be getting your 5% yield, but obviously the $1 million basis, it's kind of just education and letting them know that that can't happen. So the cons of that are that it is still fully subject to market risk, and there are no guarantees.
Yeah.
You know?
And I have clients that will layer both strategies.
100%.
They'll say, hey, look, I have $1 million portfolio. I need to get $50,000 a year off my portfolio, 5%. Hey, let's take X number of dollars, put it into an annuity that gives them that guarantee. And then they're willing to use the dividend strategy over and above that. And they're okay with that fluctuation. It's almost like almost making a very conservative, like say the dividend portfolio is more of like a moderate to even maybe sometimes moderate aggressive strategy that brings back the risk of that overall.
Correct. Yeah. And that's what's neat too, is I think as we dive into like all these different philosophies, I would personally say very rarely do you see them as sit by themselves. Right. You know what I mean? It's usually, these are like the ideas, these are kind of like the tools in the toolkit. You have these 3 different philosophies, whether it's annuity, dividend, and I'll get into number 3 in a second. But very rarely do you see them sit by themselves. You know what I mean? They usually blend them all together and kind of complement each other, right? Because, it's almost like not one answer is the perfect answer. You have 3 really good options here. Why don't we blend them all together?
Absolutely. And this is where kind of sitting down with our team and working through different ideas, different strategies, kind of answering that question. I sat with someone last week, and I've been telling him for 2 years, I'm like, listen, you can retire whenever you want. He's done a really good job saving. We've built his plan. We know where we're drawing funds from. That's another thing that I see. I sat with a couple, about a week and a half ago, and we started to look at their tax return, and they're pulling money from all these different buckets because they don't have an advisor that's ever wrapped their arms around everything, kind of showed them the best path forward. And I think that's what we do a really good job of. They were pulling money and creating additional taxes that they did not need to be paying. And they could be doing tax strategies on some of their other assets had they not generated that income. So they came on board, started to work with us, and now they have a plan going forward to kind of tackle taxes over the next 15, 20 years, and save them quite a bit of money overall. So that's when we're, like I said, sitting down with folks, going through that safety income growth methodology. Okay, look, here's what we need to put in your safe bucket, or here's what you're comfortable with seeing at the bank or in a money market fund, that money you can get at your fingertips on in one, a day or two, right? Then here's what we need to put in your income plan using 1, 2, 3 different strategies. We'll get to the third one here in a minute. Then the rest can go in that growth bucket. But then at SHP, what we're also doing is like saying, okay, we have your income plan built. Now let's layer on all these other strategies to make the whole plan even more efficient. So,
No, and I couldn't agree more, Keith. Like, again, I'll get into the third option, but what you'll see is that when we decide on the type of income that we're going to generate, right? Whether it's an annuity, whether it's dividends, or I'll get into what we call the bucket theory or the bucket approach there. Honestly, the tax status of the money that we have to deal with, whether they have a bunch of cash, IRAs, 401ks,
appreciated stock, whatever it is,
appreciated stock, yeah. So like that, basically, when we meet with them and we understand the underneath the hood a little bit of the tax status, that inherently will drive one of these philosophies.
Correct.
See what I mean?
Yes, absolutely.
So yeah, and then I'll dive into philosophy number 3 for a second, which I would say this is the type of client that value the most important thing to them, because obviously, again, we can generate income in various ways, but for those where the most important thing to them is flexibility, right? When a client is, hey, maybe they're traveling a lot, maybe they want to give to grandkids, kids or whatever that may be. If they really, really value flexibility, then we kind of do we call it in SHP, I think it's across the industry too, we call it like the bucket approach or the bucket theory, right? And long story short, really what it is it's kind of like a lot of mental accounting as well, where just mentally you start to build out different buckets. We're talking a lot about buckets, but within that income bucket or that income sleeve of your portfolio, you're going to build in buckets within it. And what I mean by that is, again, basically, let's just say, I'll go back to the example I had earlier. A client needs $50,000 to $60,000 a year from their portfolio. Okay, well then maybe $150,000 goes into extremely conservative stuff with money markets, CDs, tips, treasuries, right? Because that $150,000, that's their income for the next 3 years. right? So basically you need to set up maybe anywhere from 1 to 3 years of income in this super conservative bucket, right? And the client just knows mentally that that is the account that they're going to be withdrawing from for the next 3 years, right? And then you move on to bucket 2. Well, let's just say that's years 3 through 7. Well, then that's still going to be relatively conservative, maybe moderately conservative, maybe a diversified mix of an equity and fixed income portfolio where, again, you're not throwing all at the markets, but the idea is that bucket called years 3 through 7, as bucket 1 starts to get wind down because you're living off it, then you start to replenish it. Yeah, you start to shift it over year, depending on what the economy, what the market's giving us, right? And then lastly, maybe the more fun bucket is bucket 3. Right. Well, bucket 1, you have super conservative. Bucket 2, you're basically middle of the road there. And then bucket 3, well, then that is 7, 8, 9 years down the road. Right. So that's where we can really start to drive growth. Right. And you kind of, and really every,
have to.
Yeah, every investment plan needs growth.
I
right?
would agree. Yeah.
Yeah. You need to account for inflation. Right. Obviously, I go to the gas station nowadays and we know it's, double what it was, 2-3 months ago. Right.
Kids, a Chevy Suburban, it hurts.
So basically every investment portfolio does need some sort of growth. So I think that's where we focus on. We call it bucket 3. That's where you get into the equity markets, ETFs, mutual funds, maybe some individual stocks if you like to play in that space. You could even, again, our investment committee does a phenomenal job introducing private equity nowadays, right? Because the private markets are becoming very popular, right? So again, we don't really touch the private space in buckets 1 and bucket 2. But if you have 7, 8, 10 years on your side,
you have the timeline that dictates it.
Exactly. So that's, again, we really like the idea of when it comes to generating income, having like different buckets for different time frames. But most importantly, you'll realize that regardless if it's bucket 1, bucket 2, bucket 3, when it comes to income generation, every single one of those buckets is fully flexible, right? So that's the type of client if they're traveling a lot, or like I said, or they want flexibility, well, then that is the kind of, between the annuity approach, dividend approach, I would say the bucket approach has the most flexibility for the client. So if that's a really big driving factor, then, and of course they can stomach some market volatility. I think that's a path that we've often gone down.
Yeah. So the real con is, market volatility.
Market volatility. Yep.
Yeah.
Exactly. Yep.
So many people, I don't know if you guys as well, but so many people come in, like I said earlier, and they could have retired or, and what I always say is you can never get your health back. You can never get time back. And I like to tell people, hey, some people still want to go to work. I get it.
Yeah.
But it's empowering to know that it's more of a want than a need. Yeah. And I think having an income plan, a dedicated strategy, a dedicated plan helps people give confidence, whether it's confidence to enjoy their retirement, gift in retirement, take that extra trip, kind of live the retirement that they envision. But the problem is most people don't know. They've done a really good job saving their 401k. They've been working 25, 30, 35 years, head down, driving to work, putting their money away, but they've never picked their head up to kind of see where they're at. So if you're one of those listeners out there that just kind of want to know what's possible in retirement, have I saved enough? What is my income strategy? Why am I pulling from this bucket, or just want a second look at what you're currently doing? Feel free to reach out at shpfinancial.com. Again, we believe that every retiree needs a holistic retirement plan, a dedicated income strategy, where you're taking money from, why, how you're going to take Social Security when that time comes if you haven't. Then we start to build investment strategies, whether it's, like Chris said, a lot of it's based around income because you need that income to drive your retirement. But then after that, what do we want that growth bucket to look like? Then we start to look at taxes and start to build strategies to help better position both you and your families long-term, healthcare strategies, and then the final thing is estate planning, kind of tying this all up. And ourselves and our team manage this now and ongoing for each of the families we work with. So again, if you haven't set up a plan, if you're looking for a second opinion, or you just want to know what's possible with what you've saved, which I think is kind of the fun part of our job, kind of telling people, hey, yeah, you can go live your retirement dreams. You can go do this. Feel free to reach out, shpfinancial.com. Any other thoughts on income? Just, basically.
I think overall you wrapped it up nice where it's like, obviously at SHP, we try to do the 5 worlds. Income is the driving factor of that, right? But when we understand people's, tax goals, their legacy goals and all that, that's what allows us to put the full plan together. You know what I mean? So, I think income is the base of it, but really people's goals and what they're trying to accomplish eventually leads to all that.
Exactly. And like you said, everything is so individualized. People come in, they are super conservative or they are more aggressive, and it's really kind of build that plan. And to me and my team, that's the fun part, is like, that's the best part of my job personally, is like, not everything's the same. You know what I mean? It's really putting together that plan for that individual family. So again, if you want to take a look at what's possible for you and your plan, shpfinancial.com. Thank you all again, and look forward to seeing you next time right here on the Retirement Roadmap Podcast.
Thanks for listening to the Retirement Roadmap Podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap Podcast. And for all the attorneys out there, disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap Podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.